This is accounting. This is accounting 1105, financial accounting 2. This is going over the class lecture for learning module 2, which is going over chapter 11, current liabilities and payroll. So I want to start by saying welcome, students. This is going to be a recording, basically discussing chapter 11. As you see here, we're going to start out going over current liabilities. Then we're going to jump into payroll and talk about payroll and payroll taxes, the accounting system for payroll, employee fringe benefits, contingent liabilities, and then do a financial analysis and interpretation. So let's get started. So right off the bat, we're going to talk about current liabilities. So when a company or a bank advances credit, it's making a loan. The company or bank is called the creditor or the lender. So individuals or companies receiving the loan are then called the debtors or the borrowers. So debt is recorded as a liability by the debtor. You have long-term liabilities or debts due beyond 1 year. Thus, a 30-year mortgage used to purchase property is a long-term liability. Current liabilities are debts that are paid out of current assets and are due within 1 year. Now, we'd recently just talked about assets and what current assets are. So current liabilities are defined in the respect that they should be paid off by your current assets. And we're actually going to talk about that when we do the quick ratio at the end of the chapter, to be able to determine if you have enough current assets to be able to pay off those current liabilities. So there's 3 types of current liabilities. We're going to talk about accounts payable, the current portion of a long-term debt, and then we're going to talk about some short-term notes payable. So real quickly, we've kind of already talked about accounts payable in previous chapters, but these are transactions that involve purchases on account. So these include like purchases of merchandise, inventory, supplies, etc. For most companies, accounts payable is the largest current liability. So they hold the largest dollar value. So we're going to go ahead and jump into what we call the current portion of long-term debt. Now, long-term liabilities means that they are usually paid with installments over a long period of time. And that usually means more than 1 year. So, such installments that are due within the coming year are going to be classified as a current liability. The installments due after the coming year are classified as long-term liability. So really what this is talking about is when you are creating your balance sheet at the end of the fiscal year, you're going to be looking at that long-term liability, and you should know how much you anticipate paying in the upcoming year towards that long-term liability, because you have installment payments, which usually are consistent monthly payments. So you should be able to easily calculate that out. And you're really just going to look at what you're planning on paying in the next year. So if you look here, fiscal year ending in year 1, then years 2, 3, 4, 5, and thereafter. So the debt of $349.90 due in year 1, we would report that as a current liability because we know that's what we're going to pay in the next coming year. So if you were doing your balance sheet for 2021, and you are looking to see what portion of that long-term liability are you planning on paying in 2022. That is the amount you would list in the current liability portion for that long-term note. Here, I've pulled up a balance sheet example. This is in the back of your ebook under financial statements if you want to look at it yourselves. But what I wanted to point out was how they did the liabilities on this balance sheet. Now, they did it for the ending of the calendar year, but it could be the fiscal year because we both know either or. But here, let's focus on the liabilities. If we look here, we have our current liabilities and we have our long-term liabilities. Okay. And under current liabilities, we do see a notes payable in parentheses current portion. And then we come down here to long-term liabilities, and then we see the notes payable. Okay. So what they're saying here is in the next coming year, the 2017 or 2007, 2027, who knows, in the next coming year, they are expecting to pay about 200,000 against that notes payable. So that's the portion that they're going to put up in current liability because they're planning on paying that in the next year. So I just kind of want to show you guys, give you a visual of what it would look like on a balance sheet, and how your liabilities are listed on a balance sheet. So again, a balance sheet is comprised of the accounting equation. It has your assets, your liabilities, and your stockholders' equity. And you should be able to take the balance of your liabilities and the balance of your stockholders' equity or your owner's equity, depending on the type of business, add them together, and they should equal the value of your total assets. Because again, the accounting equation is assets equals liabilities plus equity. But right here, I wanted you to be, so this is great because it gives you a really good example of a list of current liabilities on the balance sheet and how they do have that notes payable current portion listed under current liability. I just wanted to show you guys an example of that. I thought it was really good example. And again, this is in your book. So if you want to go to your table of contents, you would just come down here to financial statements for Morning Joe, and you'll be able to see an example of these financial statements. So we have the income statement, the balance sheet, a returned earnings statement. We haven't discussed that yet. And then your stockholders equity statement. So we're going to go back to chapter 11. So this is what they basically mean. So that was an example of what they mean with they talk about a current portion of a long-term debt. So the remaining, so if you look here, they said that of the total debt, 349.9 will be listed as a current liability. And then the remaining debt, which is the total principal payments of 944.40 less the 349. So then this portion, the difference, is what you would be listing in the long-term liability section of the balance sheet. So now let's talk about short-term notes payable. So we talked about long-term and then how we want to list the current portion of a long-term in the current liabilities. But then we also have short-term notes payable. So notes may be issued to purchase merchandise or other assets. Notes may also be issued to creditors to satisfy an accounts payable credited earlier. So you could, so we look at an example here based on that. So it looks as though this Nature Sunshine Company issued a 90-day 12% note for $1,000 dated August 1st to Murray Company for an overdue account. So Murray Company purchased something on account. And most accounts payable when you purchase things on account usually have a payment terms of net 30, meaning that they expect full payment within 30 days. Sometimes for various reasons, you may not be able to pay that within 30 days. So then you would renegotiate that loan with your creditor and possibly come up with a different agreement. In this situation, the creditor, Nature Sunshine, agreed to let them pay them back in 90 days, but at a 12% interest rate. So that's a perfect example of how a accounts payable was then turned into a short-term notes payable. It's still a current liability because it's expected to be paid within a year. It's actually expected to be paid within 90 days, which is just 3 months. but it does renegotiate the terms of the loan. So how would we report this on our ledger? Well, we've already had the accounts payable set up when we purchased the items. So accounts payable is a liability, and we would record that a liability originally as a credit. Well, we're going to reverse it out of accounts payable because we're going to now, because we've renegotiated that debt, and we're going to categorize that as a short-term notes payable. So to reverse it out of accounts payable, we're going to debit accounts payable. So you see here in the first journal entry transaction example, that's exactly what they did. They debited the accounts payable, okay, for Murray Company of $1,000. Then what they're going to do is they're going to set up the notes payable portion of it. And again, it's still a liability. It's a current liability. So we're going to set that up as a credit. So we've just moved it from accounts payable to notes payable. And we went ahead and put down here in the description the terms of the note. It's a 90-day note at 12% interest. So now when the note matures, the entry to record the payment of $1,000 will have to include that interest. And it's a simple compound of interest. So here, I'm just going to click on this little asterisk. Cengage, I guess, in their infinite wisdom, decided to use a 360-day per year instead of what is normally practiced, which is a 365-day. So we'll continue with that math using the 360. But in real world applications, when you go to compound this interest or calculate the simple interest, you would use 365 days. But you simply start out by taking the number of days of this agreed upon. In this situation, it was 90 days, and divide it by the 360. And then you would take the $1,000 original loan and multiply it by the interest rate, which is 12%. So obviously 12% of $1,000 is $120. So we're going to multiply that by the 90 divided by 360. Which is 25%, by the way. So we're going to multiply 25% times the 120, which gives us the $30. That is the amount of interest we would need to pay them when the note matures. And that is a simple calculation for simple interest. Obviously, 90 days is 3 months. 3 months is a quarter of a year, and that's why that came out to be 25%. So 90 divided by 360 is basically 25%. So they're only going to have to pay 25% of the total interest. The total interest was $120. $1,000 times 12% was $120, and you only have to pay 25% of that interest because it's only a 90-day note. I hope that makes sense. So then what you're going to do is you're going to record that payment. So now they're making the payment. Obviously, they're going to reverse out the notes payable because they're paying it. So they're going to take that $1,000 credit they initially set up, and they're going to debit $1,000 against us, against that notes payable entry. And that's going to zero out the notes payable because we're paying it off. So we're going to zero it out. We don't want to still show a payable on our books if we're paying it off. Okay. But the $30 interest is an expense. So we're going to hit that using the interest expense account. And that's where we're going to record the $30 that we accrued in interest. And then our offset is obviously cash because we're paying the note. So we're paying in cash. And the total amount of cash we're going to pay for this note is $1,030. So let's look at this. A company may also borrow from a bank by issuing a note. So to illustrate, let's look at some journal entries for examples of when you may do a short-term note with a bank. So in this situation, Iceberg Company borrowed cash from First National Bank by issuing a $4,000 90-day note at a 15% interest. So How would we record this? Now, the example above was if we had an overdue bill that we couldn't pay in the 30 days and we renegotiated it to a 90-day loan with Murray Company and were able to renegotiate that and give us an extension, but we had to agree to pay 12% interest if we were to do that. This is something different. Now we're borrowing cash from a bank. So maybe we're a little short on cash. Maybe we can't meet payroll. We need to pay some bills. We know some cash is coming in, but we don't have the cash on hand. So we do a short-term loan with the bank saying, hey, I just need a little bit of cash flow. I've got some money coming in, it's just not hit yet, but I got to get these bills paid. So they agree to do a 90-day loan. So they loan you $4,000 cash that you have to pay back within 90 days. So the journal entry is going to be a debit to cash. You may ask yourself, why? Well, they gave you $4,000 cash. So they've now given you $4,000 cash that you've put in the bank. So if you've deposited $4,000 into your bank, you have to increase your cash balance on your ledger. So cash being an asset, we're going to increase cash with a debit. So that's why you see right here, our first journal entry is a debit to our cash account for $4,000. Now, our offsetting entry is where we're going to be setting up the payable. It is a note payable. So we're going to go ahead and credit that payable. Again, notes payable is a liability. Liabilities are recorded with credits. Okay, so we're going to credit notes payable. And we went ahead and put a description in here showing the terms of the note, which was a 90-day note with a 15% interest. Now, on the due date of the note, Iceberg Company owes First National Bank $4,000 plus their interest. And again, interest is calculated the same way. All right, it's a 90-day loan. So we know that this is going to be 0.25 or 25%. But let's go ahead and calculate this out. 4,000 times 15% is $600. Okay, so that would be the total interest based on if it was full year. Okay, because it's compounded daily, correct? Correct. So, or you could say, yes, compounded daily. So they only did it for 90 days. So that means that Iceberg Company only needs to pay 25% of that. So 25% of $600 is $150. So that's how we calculate how much interest we're going to have to pay. So now it's 90 days later, the note has matured and we are ready to pay it. All right, so we are going to start out by reversing our note payable entry. So here we started out with a credit to notes payable where we set up the payable. Now we're reversing it because we're paying it off. So we're going to do a debit of $4,000 to notes payable. And just like earlier, when we renegotiated our accounts payable, we have interest we have to pay. So we record that as an interest expense of $150. And because we are paying it, we're going to again reduce our cash. And we're going to reduce our cash for the total of the $4,000 plus the interest, which is $4,150. Now, in some cases, you may have what's called a discounted note. Okay, a discounted note, the interest rate on the note is called a discount rate. The amount of interest on the note is called a discount. And it's computed by multiplying the discount rate times the face value of the note. The debtor or the borrower receives the face value of the note less the discount. The amount of cash received at issuance is called the proceeds. All right, and the debtor must repay the face amount of the note on the due date. So let's look at this. This is kind of a little different. So again, we have a company. Carry Company issues a $20,000 90-day discounted note to Western National Bank. So they get a loan, and what they call it is a discounted note. They get a discounted note. Okay, so the discount rate is 15%, and so that's calculated in the same way we do the interest rate. You start out by taking the terms, which is 90 days, divided by 360. Then you take the total value of the loan, 20,000, by the discount rate at 15%. And then you multiply that by the 25%. In this rate, in this situation, the discount is $750. So the proceeds that's going to be received by Carrie Company is $19,250. So instead of receiving the total $20,000 upfront, Carrie Company is because you're getting a discounted note, is go ahead and taking that interest they would have had to pay if it was a regular loan at the back end, they're paying it up at the front, and they call it a discount. Okay, because it's a discounted note. So they go ahead and take that discount rate out before the cash is distributed to the borrower. So how that journal entry is recorded is you record the total amount of cash received. In this case, it was $19,250. You still record it as an interest expense of $750, and you record the notes payable at the total face value of the note, which was $20,000. Now, when you go to record the payment of the discounted note, okay, it is, again, you reverse out the notes payable with a debit entry because you're zeroing it out because you're paying off that debt, and you offset it with your cash entry, which is the total face value, which was $20,000. So if you look at the two, they kind of look a little reversed. It's almost as if you do this entry first and this entry second. So let's look at this example about for proceeds from a notes payable. So on July 1, Bella Salon Company borrowed cash from Best Bank by issuing a 60-day note with a face value of $60,000. Determine the proceeds of the note, assuming that the note carries an interest rate of 6%. So this is a so Bella Salon borrowed cash. Okay. So we're assuming, determine the proceeds, assuming that the note carries an interest rate 6%. All right. So proceeds would be the face value of the note. Okay. That's what the proceeds are. So determine the proceeds in the note. So it doesn't matter what the interest rate is. The proceeds of the note is always going to be the face value of the note. Okay. So now let's talk about the proceeds of the note, assuming that the note is discounted at 6%. Okay, well, then that changes because they take the discount out up front. So this was a regular loan, and this was a discounted one. So in the discounted one, you take that discount rate, which is which was calculated here. You go ahead and subtract that from the face value of the note, and that gives you the proceeds. Okay, we are going to stop this video here, and I will be doing a second video where we're going to be discussing payroll and payroll taxes.